Do you perceive that? The profound quiet? It signifies a market holding its collective breath. Precisely at this moment as I address you, the price of silver stands at $65.77. It is not plummeting, nor is it soaring. It is simply poised in a state of suspended animation, awaiting a catalyst. To the casual observer, this tableau appears uneventful. They gaze at the monitor and declare, nothing is transpiring. The excitement has dissipated. However, for the seasoned trader, this stillness is deafening. This is not a void of boredom, but rather a potent tension, akin to two formidable armies locked in a standoff on opposing sides of a vast battlefield, their gaze is fixed, awaiting the setting of the sun. We are on the cusp of the most pivotal juncture of the financial week, the weekly market close. Over the preceding 5 days, financial institutions have diligently strived to destabilize this market. They unleashed a barrage of margin rate adjustments and a torrent of short-selling contracts aiming to drive the price back down to $60. Yet, their efforts proved futile. Observe the current valuation, $65.77. We are maintaining a strategic advantage. The unwavering refusal of silver to recede is, in my 4 decades of experience, the most compelling bullish indicator I have encountered. In this market assessment, we will elucidate the historical significance of this particular Friday closing price. We will scrutinize the weekly price chart, examining why programmed algorithms are designed to initiate purchases should we sustain this price threshold. Furthermore, we will dissect the developing pattern of increasing tension, indicative of a compressed spring poised for explosive release. The institutions have expended their most potent offensive, and the market has demonstrably shrugged off the assault. Let us delve into the specifics. What is the paramount importance of this Friday? Why does the distinction between a closing price of $65 or $64 hold such weight? Is it merely an arbitrary number? Emphatically not. Within the intricate ecosystem of institutional finance, daily price fluctuations constitute mere background noise. Hedge funds do not concern themselves with intraday movements on a Tuesday. Their focus is squarely fixed on the weekly closing price, which serves as the definitive judgment. It dictates the victor of the week's market contest. Did the optimists propel the price upward, or did the pessimists force it downward? For the past 3 years, on every occasion that silver attempted a significant upward movement, financial institutions have strategically employed the latter part of Friday to precipitate a sharp decline. They orchestrated substantial sell-offs of derivative contracts immediately preceding the closing bell. The objective was to produce a visually unappealing weekly candle characterized by a prolonged upper shadow, thereby signaling weakness and deterring technically oriented traders. However, consider the present situation. We are trading at $65.77, near the zenith of the week's trading range. A closing price at this level would yield a weekly candle of substantial, solid green, a phenomenon known as a morobozu, a Japanese term signifying a candle devoid of upper or lower shadows. This denotes unchallenged buyer dominance from market opening to closing. Such an outcome sends a powerful signal to every algorithmic trading system on Wall Street, confirming the authenticity of the breakout and indicating the exhaustion of selling pressure. Most crucially, it activates trend-following systems, automated programs managing trillions of dollars, governed by a fundamental directive. If an asset concludes the week above its resistance level, initiate a buy order at the subsequent Monday's opening. The established resistance level was $65. We are presently trading above this critical threshold. Consequently, if this level is maintained for the remaining hours, these automated systems will execute their buy orders on Monday morning. This explains the palpable apprehension among financial institutions. They are acutely aware of the algorithmic surveillance and the impending wave of automated buying that will ensue next week should they fail to depress the price in the coming hours. Therefore, the current stillness at $65.77 represents the quiet interval preceding an algorithmic tempest. Let us now examine the chart formation. When a rocket ascends into the atmosphere, it inevitably depletes its fuel, necessitating a halt for replenishment or risking a catastrophic descent. Markets operate on a similar principle. Silver experienced an uninterrupted ascent from $60 to $66, a trajectory that is inherently unsustainable. Typically, following such a rapid advance, a price retracement occurs to validate the underlying support structure. However, silver did not falter. It stabilized and entered a period of consolidation, trading within a narrow band between $65.50 and $66. In the realm of technical analysis, this configuration is identified as a bull flag. Visualize a flagpole representing the sharp upward surge, followed by a flag fluttering at its apex, symbolizing the consolidation phase. This is regarded as the most robust bullish pattern, indicating that as investors take profits, new buyers immediately step in to absorb the selling pressure. A seller might exit at $66, only to be met by a buyer willing to enter at $65.80. This seamless exchange occurs instantaneously, preventing any downward price movement. This phenomenon is termed absorption, where buyers absorb sellers without allowing the price to decline. Imagine submerging a beach ball underwater. Financial institutions endeavor to push it down, but the water pressure, representing the buyers, exerts an upward force. Currently, these opposing forces are in equilibrium, resulting in the stagnant price at $65.77. However, the institutions are exhibiting signs of fatigue. Their resolve is weakening. The instant they release their pressure, the beach ball will not ascend gently. It will erupt from the water. This bull flag pattern signifies the market replenishing its energy reserves, laying the groundwork for a significant upward movement towards $70. Therefore, do not succumb to boredom induced by the static price. Embrace the excitement. It is within these periods of apparent inactivity that substantial financial gains are realized. There exists a psychological dimension to this price point, $65. For a considerable segment of investors, $65 represented an aspirational target, a symbolic moonshot. Many declared, if silver ever reaches $65, I will divest all holdings. Presently, we have attained this psychological milestone with the price at $65.77. Astonishingly, the anticipated mass sell-off has not materialized. While a few traders may have realized profits, the widespread exodus has been conspicuously absent. Long-term holders and exchange-traded fund investors remain steadfast. Their rationale? They perceive $65 not as a terminal point but as a foundational level. Observing the prevailing inflationary environment, the escalating national debt, and the recent developments concerning Samsung's battery technology, they recognize that $65 represents merely the inception of a much larger trend. This constitutes a profound psychological victory. The institutions predicated their strategy on the expectation of retail investors capitulating. They anticipated that by allowing the price to reach $65, the retail sheep would liquidate their silver holdings. However, these sheep have not succumbed. They have evolved into wolves, comprehending the intrinsic value of their assets. Their objective is no longer an exit at $65, but rather an entry point at $100. This fundamental shift in collective psychology is the genesis of a supercycle, a phenomenon where elevated prices do not suppress demand, but conversely stimulate it, leading to exponential price appreciation. I wish to draw your attention to an event that did not occur today. It is Friday, historically a period of aggressive market manipulation. Typically, following the release of employment data, the dollar strengthens and silver experiences a precipitous decline, a pattern we have observed repeatedly. We were prepared for such a scenario today, anticipating a potential drop to $64. However, this decline did not materialize. The attempted price suppression failed. The expected market reaction did not manifest. The underlying reason is the unprecedented tightness of the physical silver market. As previously discussed, dealers have depleted inventories and refiners are operating at reduced capacity. Should financial institutions attempt to force the paper price down to $64, industrial consumers will strategically intervene, acquiring additional silver at the discounted rate, effectively expressing gratitude for the price reduction. The institutions have relinquished their capacity to manipulate the price downwards. Their only recourse is to temporarily stall its ascent, maintaining a sideways trading range, but they can no longer engineer a significant price crash. Each downward price adjustment exacerbates the physical supply deficit, establishing a concrete floor at $65. We are currently navigating this reinforced floor, and its stability is palpable. Having established the market's inherent strength and the critical nature of the weekly closing price, the pertinent question becomes, what lies ahead? What transpires when the clock strikes 5 p.m. and trading activity ceases for the weekend? In the subsequent segment, we will dissect the algorithmic activation mechanism. I will provide a detailed explanation of the operational principles governing trend-following models and illustrate why a closing price above $65 will trigger a substantial influx of capital inflows on Monday. Furthermore, we will address the inherent risks associated with weekend holding periods, elucidating why maintaining a cash position over the weekend is precarious, while holding physical metal offers a sanctuary. The conflict is not yet concluded. A few hours remain, but the tide has decisively turned. The institutions are demonstrably on the defensive. Please remain engaged for Part 2, where we will offer an in-depth examination of the underlying mechanics. For those just joining us, allow me to provide a concise summary of the current situation. It is Friday afternoon, and the closing bell is fast approaching. The price of silver is holding firm at $65.77. We have successfully navigated the morning's price suppression attempts and the profit-taking maneuvers. We stand on the precipice of achieving the highest weekly closing price in decades. In Part 1, we explored the intricacies of human psychology, encompassing feelings of relief and vindication. However, in Part 2, our focus shifts to a more dispassionate, purely mathematical domain, the realm of algorithms. In contemporary financial markets, approximately 80% of trading volume originates not from human traders, but from algorithmic execution. These sophisticated systems, known as commodity trading advisors, CTAs, manage hundreds of billions of dollars. At this juncture, they are all observing the same critical price level, $65. For the past month, these algorithmic entities have adopted a cautious stance, awaiting definitive confirmation. However, should the closing bell ring in the coming hours with the price exceeding $65, a fundamental switch will be activated within their programming, transitioning their logic from a state of wait to execute. In this section, I will meticulously unravel the mechanism of this algorithmic switch. I will demonstrate why Monday morning could witness a tidal wave of automated buying, driven not by news events, but by the inherent logic of code. Additionally, I will elucidate the concept of weekend risk, explaining why holding cash over the ensuing 48 hours could represent the most perilous trading decision one can make. The human element has fulfilled its role. They have steadfastly defended their positions. Now the automated systems are poised to assume control. Let us venture into the operational core of a trading algorithm. These programs are designed as trend followers. They are indifferent to factors such as solar panel production or national deficits. Their sole concern is market momentum. From the perspective of a trend-following algorithm, a resistance level functions as a definitive stop sign. As long as silver remained below $65, this stop sign remained erect, prompting the algorithm to maintain a passive stance and hold cash reserves. However, when the price establishes a weekly closing above a resistance level, this stop sign transforms into an illuminated green light. This strategic shift initiates a breakout protocol. The underlying logic is straightforward. If the price breaches the established ceiling, that ceiling is effectively eliminated. Billions of dollars in passive capital are directly linked to this specific directive. Should we conclude today's trading session at $65.77, these funds will engage in a portfolio rebalancing exercise over the weekend, calculating their optimal position sizing. Consequently, on Sunday night or Monday morning, they will execute market buy orders to fulfill their allocated investment targets. This is the underlying reason why Mondays immediately following a breakout often exhibit such pronounced volatility. It represents the influx of significant institutional capital. Retail traders may have bought the rumor, and industrial consumers may have bought the dip. But now, managed futures funds are buying the trend. This buying pressure is relentless. It is unperturbed by minor price fluctuations of 10 cents or even $10. The objective is to achieve a predetermined allocation, and the buying will continue until that target is met. Therefore, if you are contemplating a sale at this juncture, bear in mind that you would be divesting into the operational maw of a machine that has just been activated. Let us now address the forthcoming 48 hours, the weekend period. Typically, traders harbor an aversion to holding positions when markets are closed, fearing the potential for overnight price gaps and the impact of adverse news. However, within a burgeoning bull market, particularly one characterized by currency instability, this risk dynamic is inverted. The genuine risk lies not in holding silver, but in holding dollars. Consider the prevailing geopolitical climate, the inherent fragility of the banking system, and the persistent rumors of export restrictions, topics we have previously explored. These destabilizing factors do not cease their influence simply because the New York Stock Exchange adjourns. Should significant news emerge on a Saturday, or if a major mining operation experiences a strike, or if a government releases unfavorable inflation data, there is no mechanism to acquire silver. The market is dormant. You remain exposed to your fiat currency until Sunday evening. Upon the market's reopening on Sunday, it is highly probable that the opening price will differ significantly from the previous closing price, potentially gapping up to $67 or $68. If you are holding cash, you will have experienced a depreciation in your purchasing power while you slept, and you will be unable to re-enter the market at the prior price. This apprehension of missing out on potential gains is a primary driver of the heightened importance placed on the Friday closing price. Sophisticated market participants recognize that the weekend represents a period of information vacuum. They prefer to hold tangible assets through this volatility rather than be caught holding depreciating fiat currency. This is precisely why we are not witnessing a significant sell-off today. No one desires to be holding purely cash over the weekend. The prudent strategy has shifted to holding silver, while the inherently riskier position is now holding dollars. This represents a fundamental paradigm shift. There is another discernible signal emerging: the media. For years, prominent financial news outlets such as Bloomberg, CNBC, and the Wall Street Journal either disregarded silver or derided it, labeling it a pet rock and dismissing its proponents as irrational. However, observe the recent headlines. Silver outperforms gold. Solar demand creates supply squeeze. Is silver the new lithium? The prevailing narrative is undergoing a perceptible transformation. Why is this significant? Because the media possesses the power to influence the collective sentiment of the general public. The average individual does not meticulously analyze price charts or pore over mining reports. They invest based on what the media designates as trending. As mainstream media outlets begin to validate the narrative of a supply shortage, it effectively grants permission to the average investor to enter the market. It signals to financial advisors that allocating client capital to silver is a prudent decision. It reassures pension funds that silver is a legitimate asset class. This represents the convergence of substantial capital. We have discussed the influence of large institutional players and algorithmic systems, but the most significant reservoir of capital resides with the general public. They are invariably late to the party, but they invariably bring the most substantial financial resources. When the masses arrive, market valuations can reach irrational levels. They are unconcerned with precise price levels like $65. Their sole focus is on upward momentum. We are witnessing the nascent stages of this widespread public acknowledgement today. Articles are being published and segments are being filmed. In the coming week, the retail investor who has previously disregarded your insights might contact you seeking guidance on acquiring silver coins. While this represents a lagging indicator of price action, it serves as a leading indicator of an impending speculative fervor. We are transitioning from an era dominated by smart money to a phase characterized by broad public participation, a phase where prices typically exhibit parabolic ascent. Finally, let us revisit the options market. While we have previously discussed the phenomenon of a gamma squeeze, there is also the critical concept of maximum pain. Every Friday, options contracts reach their expiration. market makers endeavor to manipulate the price towards a level where the greatest number of options expire worthless, typically by attempting to pin the price near the midpoint. However, today, they have relinquished control. Numerous call options at the $65 strike price are now in the money, obligating the institutions to deliver the underlying metal to the option holders. Should we conclude the trading day at $65.77, the institutions will enter the weekend acutely aware of their short inventory position, unable to hedge their exposure. They will be compelled to await Monday morning with a degree of apprehension, hoping for the absence of adverse news. This scenario cultivates palpable anxiety within their executive suites. Consequently, on Monday morning, their immediate priority will be to cover their short positions, purchasing the metal to offset the exposure they were unable to hedge on Friday. Therefore, the Friday closing price acts as a slingshot mechanism. The higher the closing price today, the greater the number of in-the-money call options, and consequently, the more substantial the forced buying activity on Monday. This is a mathematical certainty. The derivative market is dictating the physical price, and at this moment, the derivative market is issuing a resounding buy signal. Consequently, the algorithms are poised for activation, weekend risk is elevated, the media narrative is shifting, and the institutions are strategically cornered. The pertinent question now becomes, where precisely are we headed? What are the projected price targets? If $65 represents the floor, what is the ceiling? In Part 3, we will embark on a comprehensive examination of the technical roadmap. I will meticulously detail the Fibonacci extension levels that precisely forecast potential consolidation points for this rally. We will analyze the $70 target, elucidating its significance as the next major battleground. Furthermore, I will explain the formation of the cup and handle pattern on the monthly chart, a configuration that has been developing for 45 years and suggests a trajectory towards price levels that may seem inconceivable today. The weekend is approaching, but the charts are perpetually active. Let us explore the price targets. Stay tuned for Part 3 as we chart the course to unprecedented heights. Having accompanied me through Part 1 and Part 2, you now possess a comprehensive understanding of the market's dynamics, the fundamental drivers, the prevailing shortages, the institutional apprehension, and the algorithmic recalibration. While fundamental analysis guides investment decisions, technical analysis dictates the timing and trajectory of price movements. At present, observing the market at $65.77, we are not merely looking at an arbitrary figure, we are witnessing the culmination of a geometric pattern that has been meticulously constructing itself for 45 years. In Part 3, we will set aside speculative news headlines, disregard pronouncements from the Federal Reserve, and defer considerations of mining operations. Our sole focus will be on the mathematical underpinnings of price action. I will meticulously detail the cup and handle pattern, arguably the most potent formation in technical analysis, and demonstrate why it points towards a target that, while sounding extraordinary to the uninitiated, appears mathematically inevitable to the seasoned technician. I will guide you through the Fibonacci extensions, which map out the projected path towards $72. Additionally, I will explain why the Relative Strength Index, RSI, indicates that, despite the current rally, silver is not overvalued, but is in fact just commencing its ascent. The fundamental narrative serves as the engine, while the technical chart functions as the navigational system, and this navigational system indicates a considerable journey ahead. Broaden your perspective. Cease fixating on the 5-minute or daily charts. Access the monthly chart, extending back to 1980. What visual cues do you observe? You will notice a significant peak in 1980, reaching $50. This was followed by a protracted bear market spanning 3 decades, characterized by a prolonged, rounded bottom formation. Subsequently, another peak materialized in 2011, reaching $50, thereby completing a vast cup formation, a bullish shape that required 3 decades to materialize. From 2011 to 2024, we have observed the formation of the handle, a period of downward drift, consolidation, and the systematic divestment of weaker hands. And now we are witnessing the breakout from this handle. This constitutes the cup and handle pattern. In technical analysis, a broader base invariably leads to a higher trajectory. A pattern that requires 45 years to develop does not resolve with a mere $2 price increment. It resolves with a measured move. To calculate the target, we ascertain the depth of the cup measured from its approximate bottom around $4 in 2001 to its rim at $50, yielding a range of $46. This range is then added to the breakout point. $50 plus $46 equals $96, representing the technical target derived from this formation. $96 per ounce is not a speculative prediction. It is a direct application of geometric principles based on observed market behavior. We are currently trading at $65, representing merely 1/3 of the measured move's progression. This indicates that we are in the nascent stages of the cycle, not approaching its conclusion. The breakout above $50 served as the starting pistol. All subsequent price movements, the progression to $60, the subsequent consolidation, and the advance to $65 are simply market confirmations that the pattern is actively unfolding. Now let us zoom in for a more granular perspective. We will examine the intermediate price targets. Traders frequently employ a tool known as Fibonacci extensions, which are derived from mathematical ratios found in nature, such as spiral galaxies and seashells, as well as in human psychology. Markets tend to exhibit price movements that align with these ratios. The most significant ratio is 1.618, commonly referred to as the golden ratio. By measuring the price swing from the low of $20 to the breakout point of $30 and projecting this upward, the golden ratio extension converges at approximately $72. This explains why $65 should be viewed as a temporary resting point. The algorithms, the automated systems discussed in Part 2, are programmed to target these Fibonacci levels. They initiate purchases upon a breakout and establish their take-profit orders at the subsequent extension points. Therefore, the projected trajectory unfolds as follows. We are currently consolidating within the $65 zone. Once this level is firmly established as support, a process that is actively underway, the magnetic pull will shift towards $72. The price history between $65 and $72 reveals minimal price memory, indicating a period where the asset has not spent significant time, thereby implying low resistance. Consequently, the movement from $65 to $72 could transpire at a considerably faster pace than the progression from $20 to $30. The air becomes thinner at these higher altitudes, facilitating more pronounced price movements. Therefore, if you observe silver surging to $68, $69, or $70 next week, do not be surprised. It is merely the market filling the vacuum leading up to the golden ratio target. I must caution you regarding a common error. Novice traders often consult an indicator known as the Relative Strength Index, RSI, which measures market momentum. When the RSI exceeds 70, it is conventionally interpreted as an overbought condition, prompting textbook advice to sell. Currently, the daily RSI for silver is elevated, signaling an overbought state, which leads many novices to liquidate their positions, anticipating a price collapse. However, here lies the crucial insight. In a robust, trending bull market, an overbought reading is not a harbinger of decline, but rather a testament to underlying strength. An asset can remain in an overbought state for extended periods, even months. Consider the trajectory of Bitcoin in 2017 or Nvidia in 2024 as illustrative examples. They exceeded typical buying thresholds and then advanced further, doubling their value, and then they ascended again. The reason for this phenomenon is the overwhelming intensity of purchasing demand, which pushes indicators to their extreme upper limits. Such a situation renders the indicator ineffective as a signal for selling. Instead, it transforms into an indicator of acceleration. To divest yourself of your silver holdings simply because the Relative Strength Index, RSI, shows an elevated reading is akin to confronting a firearm with a blunt object. You are opposing an unstoppable force because the speedometer indicates a rapid velocity. Yes, it is indeed accelerating rapidly. That is precisely the point. The weekly RSI, a significantly more potent indicator, remains far from its historical peak values. In 1980, the weekly RSI reached 95. In 2011, it climbed to 90. Presently, it is in the 70s. We possess substantial potential for further appreciation before the market enters a state of true euphoria. Do not permit the designation of overbought to deter you from participating in the generational investment trend. Markets can sustain irrational valuations for extended periods, exceeding your financial capacity to short them. There exists one final technical element for consideration: round numbers. Humans are drawn to figures ending in zeros and fives. We find 65 and 70 appealing, and 100 is particularly attractive. These numerical thresholds function as gravitational attractors. When the price approaches them, it is drawn inward. We have just surpassed the $65 mark. The subsequent significant level is $70. The rationale for $70 is its status as a psychological benchmark. It elicits a perception of being expensive. Sellers will be poised at that level. I intend to divest at 70. However, in a scenario of scarcity, these round numbers serve as refueling stations. The price reaches $70. Sellers liquidate their positions. Yet, astute buyers, such as major corporations like Samsung and Microsoft, and even national entities like China, absorb all the available supply. The price experiences a temporary plateau. Subsequently, once the sellers have been depleted, the price surges through the round number. We witnessed this occurrence at $30. We observed it at $50. Most recently, we saw it at $65. We anticipate witnessing it again at $70. Avoid attempting to precisely time these levels for trading purposes. Do not attempt to sell at $69.99 with the expectation of repurchasing at $68. You could execute a sale only to witness the price leap to $72 while you are asleep. During a short squeeze, attempting to trade around these critical junctures is a highly effective method for relinquishing your established position. The prevailing trend is upward. The significant price levels are situated above us. The force of gravity is operating in reverse. Therefore, the technical charts indicate a bullish outlook. The Fibonacci retracement targets suggest higher levels. The cup and handle chart pattern is active. However, charts alone do not generate revenue. Effective execution is what generates profit. How will you navigate the subsequent 48 hours? How will you manage the emotional complexities of holding a profitable position over the weekend? In the forthcoming segment, the concluding part of this series, we will transition back to strategic considerations. I will provide you with the weekend protocol. I will elucidate the reasons why you should deactivate your mobile device, and I will conclude with a final reflection on why inaction represents the most challenging yet most lucrative strategy in the current environment. The closing bell is on the verge of sounding. The trading week has been successfully concluded, but the overarching battle persists. Remain tuned for part 4. We are bringing this endeavor to a successful conclusion. We have reached the culmination of the trading week. The closing bell is resonating in New York. The automated trading systems are disengaging. The financial professionals are departing for their weekend residences in the Hamptons, and the price of silver stands firm at $65.77. Take a moment to pause. Inhale deeply. Do you comprehend the significance of what has just transpired? The financial institutions deployed every conceivable tactic against this market. They attempted to engineer a collapse on Friday morning. They were unsuccessful. They endeavored to initiate a sell-off during the midday trading session. They failed. The market absorbed every single assault and maintained its integrity. This week will be etched in the annals of financial history. We breached the $65 barrier. We triggered the gamma squeeze. We compelled the short sellers to cover their positions. However, we now enter the most perilous phase for an investor, the weekend. For the ensuing 48 hours, the financial markets will be dormant. You will be unable to purchase or sell. You are left in solitude with your ruminations. You are left alone with the prevailing news narratives. And it is precisely at this juncture that errors are committed. In this final installment, part 4, I will impart the weekend protocol to you. I will instruct you in the most demanding discipline within finance, the mastery of inaction. I will expound upon why overthinking during the weekend is the most expeditious route to jeopardizing your position on Monday. The conflict for the week has been resolved. Now you must achieve a state of peace. Let us bring this to a successful close. There is a celebrated anecdote concerning a prominent trader named Jesse Livermore. He was recognized as the preeminent trader of the 1920s. He amassed immense wealth during the great market crash. One day, a novice trader inquired, "How did you accumulate such substantial wealth? Did you capitalize on breakouts? Did you initiate short positions during market declines?" Livermore regarded him and responded, "It was never my analytical thinking that yielded significant profits for me. It was consistently my ability to remain sedentary." Remaining sedentary. It sounds deceptively simple. It is, in reality, the most arduous undertaking imaginable. At this moment, you are either benefiting from substantial gains or holding a significant position. Your mind will exhibit a predisposition to act. It will desire to secure the profit. It will seek to mitigate risk. It will feel compelled to make adjustments. This weekend, you will encounter various news reports, perhaps a geopolitical rumor, possibly a disquieting article concerning interest rates. Your cognition will suggest, perhaps I should liquidate half of my holdings early Monday morning as a precautionary measure. Perhaps I should acquire a put option. This inclination is your adversary. In a supercycle, which is the economic environment we are currently experiencing, substantial wealth is generated by identifying the prevailing trend and then steadfastly maintaining your position until that trend is decisively broken. Has the trend been broken? No. We have just concluded the trading week at our highest point. Has the scarcity concluded? No. The refineries remain inoperative, so why would one deviate from the current strategy? The Livermore principle dictates that if a trade is performing favorably, refrain from interfering with it. Do not prune a blossoming tree this weekend. Your primary responsibility is to suppress the impulse to appear astute. Seeking to appear astute can prove detrimental. Cultivating patience, conversely, leads to prosperity. You must comprehend the dynamics of the media cycle. Financial news channels require viewership throughout the weekend. However, the markets are closed. There is no price action to report. Consequently, what do they resort to? They engineer apprehension. They will present an individual who contends that silver is in a speculative bubble. They will feature an analyst who asserts that the $65 level represents a double top formation. They will construct narratives designed to keep you fixated on the screen. You must disregard this weekend's manufactured sensationalism. Recall that the individuals appearing on television are not in possession of physical silver. They receive fixed salaries and are compensated in fiat currency for reading from a teleprompter. They do not grasp the implications of Samsung's battery technology. They are unaware of China's export restrictions. If you permit this extraneous information to infiltrate your consciousness over the weekend, you will awaken on Monday morning filled with anxiety. You will scrutinize the pre-market activity at 4 o'clock in the morning and will actively search for a justification to sell. The instant a minor dip occurs, you will execute the sale. Subsequently, 2 hours later, the price will surge to $70, leaving you behind. This is how your position is undermined. They utilize the weekend to sow seeds of doubt. Your defense is straightforward. Disengage. Refrain from checking the news. Abstain from visiting online forums. Engage in outdoor activities. Spend time with your loved ones. The price will still be there on Monday. Staring at it on Saturday will not alter its trajectory. Nevertheless, we must be prepared for Sunday evening, given the strength of this closing performance, particularly our sustained holding at $65.77. The likelihood of an upward price gap on Sunday is substantial. When the Asian markets commence trading, they will observe this weekly candle pattern. They will note the failure of the American banks to suppress the price. This indicates a degree of weakness in the Western markets. Consequently, the Eastern markets may initiate an upward movement. We could witness silver opening at $66.50 or even $67 on Sunday evening. Should this scenario materialize, do not pursue it with leveraged positions. Gaps are frequently retested and filled. The price may experience an initial surge, followed by a retraction to $66 to test the support level. If you are contemplating increasing your holdings, refrain from purchasing during the initial spike on Sunday evening. That constitutes a panic buy. Await the retest, allow the market to stabilize. However, if you are already invested, simply maintain a positive disposition. An upward gap signifies that supply is so constrained that the price must instantaneously ascend to locate sellers. Conversely, should unfavorable news emerge and we experience a downward gap to $64, do not engage in a panic sale. Recall the concept of the bear trap. A downward gap on a Sunday is frequently met with buying pressure by Monday lunchtime. Adhere to your established plan. Remain aligned with the prevailing trend. I wish to conclude with a reflection on conviction. For years, silver investors subsisted on hope. We harbored aspirations that market manipulation would cease. We anticipated that industrial demand would materialize. We wished for a depreciation of the dollar. This week, that hope has been extinguished. It has been supplanted by a profound sense of certainty. We no longer need to harbor hopes. We witnessed the bank's inability to engineer a price collapse. We observed the confirmation of Samsung's battery technology advancements. We saw the $65 resistance level disintegrate. We are no longer engaging in speculation based on theory. We are actively shaping reality. The deficit is tangible. The scarcity is undeniable. The price action is concrete. This paradigm shift in our perspective is of paramount importance. When one operates from a position of hope, one is easily intimidated. When one operates from a foundation of certainty, one becomes unshakable. You are holding an asset that is profoundly undervalued in the entire history of finance. It is occurring at the precise moment when it is being revalued by a world in desperation. You do not require hope. You simply need to exercise patience. Therefore, here is the verdict for the week. The proponents of the bull market have triumphed. It was not an effortless victory. It was a grueling contest, but we concluded above the critical threshold. The technical indicators are signaling an advance towards $72. The fundamental factors suggest a trajectory towards $100. The prevailing sentiment is transitioning from apprehension to a fear of missing out. Next week, the contest will likely pivot to the $70 level. It will be characterized by volatility and apprehension. However, you are prepared. You possess the roadmap. You are equipped with the necessary defenses. Enjoy your weekend. You have unequivocally earned it. The closing bell has sounded, and for the first time in 45 years, it carries the resonance of victory. Subscribe.